All right, what's going on YouTube? So today we're gonna be talking about lot size and pips. This is the foundation of trading. If you guys already understand what lot size and pips are, you guys can click off of this video. But if you guys are still beginnings or you guys are struggling with your risk management and stuff like that, make sure you watch this video to the end. You know what I'm saying? I know y'all got the freaking attention span of a squirrel, but I'm gonna try to bust this down for y'all, make it quick, short, simple, and easy for y'all to understand. All right, so we're gonna talk about it. What are lot sizes and what are pips? All they are units of measurements. All right. So just like if you had a freaking if you were about to bake a cake and you were using a measuring cup and you got quarter cup, half cup, three-fourths of a cup, and the box says put a half cup of oil in there. Those are units of measurements. All right. So the same thing goes with lot size and pips. But all the lot size and pips are, they correlate with each other. So these two things correlate with each other, and they just tell us, okay, this is how much money you're willing to risk and how much money you could potentially lose and how much money that you could potentially gain per trade. Okay, so look, we're gonna start off with the simple numbers: 0.01, 0.10, 1.0, and then I'm gonna do a 10 lot. So you don't really need to know like the terms behind these, but in case you wanted to know, we got a micro lot, mini lot, and a standard lot. This would just be 10 standard lots. All right, so for this first example, we're just gonna go over 10 pips. So every 0.01 for 10 pips, that is equivalent to $1. Therefore, this would be $10. The one lot would be $100, and the 10 lot would be $1,000. All right. All it is some multiplication. You just have to remember that every 0.01 is equivalent to $1. All right. That's if price moves 10 pips. So pips is the change of price on a particular pair, and your lot size is the amount of units being traded. All right. So let's say that we changed this number to a 4. This now becomes $4, $40, $400, or 4,000. You know what I'm saying? So look, what I want y'all to realize is, number one, each of these moves are the same thing. All of these are the same exact move. It depends on how much capital you have. So I don't want you guys to be discouraged if you guys are just making $4 or $40 on the trade, because that's very good. That's literally the same thing as making $400 or $4,000 on. It's just somebody else has more capital than you. So that same exact move that you might be taking, like you guys see all these people on Instagram and stuff like that taking trades that they're having these big $20,000 days and stuff like that. You might have literally caught the same exact move. It's just that you don't have enough money in your account to be risking, and you have to build your way up to that point. Okay, so when it comes to like your risk to reward, you always want to have at least a 1-to-1. Oh shoot, I said 1 to 10. 1-to-1 or better. So better would mean like a 1-to-2, 1-to-3. For this example, I'm gonna use a 1-to-3. So on this trade, right? Let's say this 1-to-1 meant we were risking, let's say it was a 0.10. That would be $40. Or let me actually do this. My bad, y'all. We're gonna change this real quick. So that would mean you're risking $40 to potentially make, what the heck? To potentially make $40. Okay? Now on a 1-to-3, that would mean you're risking $40 to potentially make $120. So I just changed that. This is the difference between a 1-to-1 and a 1-to-3. Okay, you guys have to know this because it's ultimately going to determine how much money like you're going to be in profit and how you cover your losses and things like that. Now, although I say you should aim for a 1-to-1, not every trade is going to be a 1-to-1. You can let trades run for a 1-to-5, 1-to-3, 1-to-6. I'm just pointing out random numbers and stuff like that. But just remember that you're not always going to catch a 1-to-10 on every single trade. If you try to do that, you're just like, at that point you're being greedy with the market, and it's like the market knows when you're being greedy. I swear, like you think like you'll think the trade's gonna keep going, all of a sudden just to reverse on your ass, and then you be tight because you just lost all the profit that you had, and then like you're like, dang, like I could have really been up like 500 on this day, but instead I only made 200, or I even lost money because I didn't move my stop loss to break even or something like that. Like imagine being up $400 and then end up losing 200 still. You were like, dang, like, but like if somebody would have just give you $400 on the street, you would have took it like that. You know what I'm saying? So you got to learn how to not be greedy and understand that you're not gonna catch 600 pips every day or nothing like that. Like, well, you're not gonna catch 600 pips in the day in general, unless some wild, crazy stuff happens, like with news and stuff like that. But I've never seen that happen, and I don't know if that's ever happened. So let's say I'm gonna just change the lot size for you guys real quick. Oh, don't go back farther than that. That's annoying. All right, so look, let's say we just change this right to a 0.3, 0.30, a 3, and a 30, right? And then we'll change this to 30. That means that we are now risking $9, $90, $900, and $9,000. Big 9,000. You know what I'm saying? And the reason why is just because it's literally just simple multiplication. And like I said, always just remember that every 0.01 is $1, not like 10 cents or something like that, because I understand that could be a little bit confusing. When it comes to the actual price movement of the pips, actually I'll show you guys that a little bit later. Okay, I'll show you that when we get to the chart. So let's talk about it. We're gonna go over trades for the week, right? So for this example, I'm only gonna use a one lot. I'm gonna keep it simple. We're only gonna use a one lot. Let's say like we're pretending that we used a fixed lot size the entire week, and we used a one lot. All right. So Monday we risked 10 pips. Tuesday we risked 5 pips. Wednesday we risked 26 pips. Thursday we risked 13, and then Friday we'll say we risked 22 pips. All right. How much money would this be in money? How many pips would be the same amount for the money, right? So like I said, this is a one lot. So this would mean every 10 pips is equivalent to $100. So on Monday, that means you risked $100. On Tuesday, you risked $50. Not 500, but 50, because every 10 pips is equivalent to $100 if we're using a standard lot. Because if this were to be like a 3 lot, these numbers would change. This would be 300. This would be what is that, 150, whatever. Okay. So like I was saying, so 26 pips, that will mean on Wednesday we risked $260, and on Thursday we risked $130, and on Friday we risked $220. Now I want you guys to remember these prices are the amounts that you are willing to lose. Okay, this is that first part of like risk to reward, because remember how I said you want to get a 1-to-1 or a 1-to-3 or something like that. This section right here is this side of it. Okay, so just remember that this is how much you're willing to lose. This is how much you're willing to lose in pips. This is how much you're willing to lose in money. These are equivalent to each other and everything, okay? So let's pretend on Monday we ended up winning that trade and we got a 1-to-2. So we got 20 pips. On Tuesday, we end up losing the trade. So we end up getting -5 pips. On Wednesday, we end up gaining 50 pips. Okay. On Thursday, we end up making 26 pips, and then on Friday we end up losing 22 pips. Now, how much is this in money? This is in pips. How much in money is this? So now we're going back to here. How much money are you making in pips? So here we were this is how much we are risking in pips. This is how much we are making or losing in pips. So you're multiplying it by your lot size. So on Monday, we would have made $200. On Tuesday, we would have lost $50. Let me just do this so I gotta keep switching the colors. On Wednesday, we end up making $500. Why? Because this multiplied by that, it's 500. Not 50, but 500, because pips is a little bit different than just like your regular math. Like it's per pip, okay? And then on Thursday, you would have made $260. Okay? So here on Thursday, you had a 1 to 2 risk to reward that you gained. Here you had a 1 to 2. Here you lost your trade. Here you lost your trade. And then yeah, this was a little bit underneath the 1 to 2. Okay, so how much would you have made for the week? 760, 860 minus 20. 860, 640, and then what, 510? I mean 590. Hold on, let me just do the math. I think I did that right in my head, but I don't know. I'm kind of blanking right now. Plus 260 minus 220, 690. Did I say 690 or did I say 590? I don't know. But that means you would have made 690 for the week. 690 for the week. That's very good. Okay, that's a good week. That's a great week. All right, but I want to show y'all one more thing though. Let's say, for example, because I know I said the thing that about like you want to get like a 1-to-1 risk reward and things like that. But let's say here we get stopped out at break even, and we get 0 pips. Okay, let's say we get stopped out at break even and we get 0 pips. Now, technically you'd be making $0. But what I want you guys to realize is that there's still spreads and commissions. So each time you place a trade, your broker will take spreads and commissions off of that trade. That's how they make their money. They make their money off of your losses, and they make your money off of spreads and commissions. Okay, so in reality, if you caught 0 pips, like let's say you move your stop loss exactly to break even, realistically you'd probably lose like $12 or something like that, or it could be more or less. You know what I'm saying? Like it just depends on your lot size and what your broker is and all that stuff. Okay, because it could be more or less than just $12. You know what I'm saying? So what I do to avoid this is I move my stop loss. Whenever I'm moving my stop loss to break even, I'll move it like 3-4 pips in profit, because in that case I won't lose anything. It'll just close me out with a very small gain, or even break me off at 0, which is like, it's pretty rare to break you off exactly at 0. So it's most likely going to be like a very, very small loss or a very, very, very small win. All right. Now, one more thing I want to say before I go into the chart, because I want to show you guys something on the chart. Let's say we end up getting 15 pips this day. Now look, you didn't completely get the 1-to-1 risk reward, but I want you guys to realize this is still a win, and that you would have made $150 that day. Okay, and so then you would have only lost $50 for the whole week. The reason why we don't have a 1-to-1 here, because I know I said we want to always have at least a 1-to-1 or better, is because this can happen. Let's say we have price moving, right? So this is how price works. Okay, let's say we placed our trade right here, and then we had a stop loss right here, and price started moving in our favor. But we decide, okay, price is moving in our favor, so we're gonna take out our stop loss. So our stop loss is gone. Our entry point is still the same, but we decide to trail our stop, and we move our stop loss right here. Okay, so this means that if price comes back, you won't lose. You'll make the amount of pips that you already had gained. So if price decides that it wants to come back, right, it'll take you out of the trade automatically. Your stop loss is there to protect you originally. So down here, your stop loss is there to protect you. It's just saying, like, if we go past here, that's how much I'm willing to lose. Okay, and that's where all of these numbers come out. This is how much you're willing to lose. But when you move it to break even, or when you trail your stops, you're gaining. Like, if it comes back, that's the amount of pips that you get. If it comes back to your stop loss. If it comes out and takes out your stop loss, that's how much money you made. All right. So although we didn't get the little 1-to-1 here, we ended up making 15 pips. That's still a winner. I want you guys to know that that is okay. All right. To trail your stops, that's okay. You're at the end of the day, we're still in profit. So I hope I made everything very easy for y'all. I don't know if I could make it even more simpler, but like, that's literally all you have to worry about. So like, when we come to the chart, I want y'all to realize we have this little tool right here, right? So the reason why you want to kind of know the math behind it too is because, so look, this right here, 20 pips and 10 pips. So we have this little tool right here that'll give you how much your stop loss is and everything like this. So let's say we pop the one lot. Let's say we pop the one lot on this trade. This is negative 10 pips, so that would be $100 that you're willing to lose, and then we end up making 20 pips, which would have been a $200 gain if it hits your TP. So if price just went like this and hit your TP, your take profit. All right. Now look, we have this tool, and that will give you a pretty accurate amount of pips for your stop loss and take profit. But I want you guys to realize the math behind it. So now we're gonna look over here. All right, because you need to understand this, because your broker might not necessarily have the exact same numbers as the price on the chart. It might be a couple pips off. Then plus, like I said, there's spreads and commissions. So you might think that you're getting in here, but on your broker, you really ended up getting in here. And so now this becomes, instead of 20 pips, it becomes like 18 pips or something like that. And then you're going to be like, yo, why did I make the full 200s? Because they took out spreads and commissions, but the spread got you in at a later price than you actually wanted anyway. So looking over here, like I said, the math behind it is like this. So if we are at, so this says, this is actually pretty good. Wherever I put the thing, it says 1.25600. When we go down, if we end up going down and hitting stop loss, that will mean we're getting out at 1.25400, or no, in this case it's 500. That is a 10 pip stop loss. Okay. All it is you're subtracting these numbers and you're getting that. It says, I know it says 100, but like, look, don't necessarily worry about this. Just remember that this is 10 pips on gbpusd. It's different for other pairs like gbpjpy, so you have to be careful. Just I would just look up on Google or like baby pips or something, just how to calculate these, because they're different on all pairs.